Hi, my name is Kunal, and welcome to the Geeks of the Valley podcast, which connects with some of the brightest minds globally who are leading their respective industries today to discuss the hottest upcoming industry trends and how their work is affecting the global economy. This morning, from the San Francisco Bay Area, we have the Global Managing Director of HSBC Strategic Innovation Investments joining us. Please welcome Ore Adeyemi. Ore, thank you so much for joining us today.
Thanks, Kunal. Thanks for having me.
And how are things with you in light of COVID?
I'm doing great. It's no complaints. It's getting cold here in the Bay Area, but otherwise we're staying indoors and trying to make the best of it.
I'm happy to hear that. Let's jump into the first question here, shall we?
Let's go.
Tell me about yourself and your background and how it led you to the path of becoming a CVC.
Thanks, Kunal. My background actually touches on three continents: Africa, Europe, and North America. And I consider these places home. These three places home for me. So I was born in Nigeria, grew up in Nigeria, and then moved to the U.S. Started university in the U.S. While I was in university, I got exposed to the world of startups and venture capital. And even started a company there with a friend. Decided to move on to consulting after graduation. And after I did consulting for a few years with Booz Allen, moved on to do my MBA. And it was right after my MBA that my journey of investing started soon after I joined HSBC. So I joined HSBC in London and doing M&A advisory for a few years, and the opportunity opened up to join a principal investing team at HSBC a few years into my advisory work. So I joined principal investing, which was more private equity, large buyouts. Did that for a few years, about 5-6 years. And then another opportunity opened up at HSBC as well to start doing venture investing. So I've been very fortunate that what I've always been interested in for several years, I was able to get into it at HSBC. And so right now I am part of HSBC's corporate VC arm, which I lead, and we invest in companies strategic to the bank globally.
What a background, Ore. And I guess as a global managing director of HSBC Ventures, what is, the fund size, investment philosophy, and how does your ticket size vary?
Well, actually, we don't have a fund size, and like most corporate VCs, we're not actually a fund. We invest from balance sheet, and so as the opportunity arises, we're able to go through our process and see if there's a connectivity to the themes that we have within our HSBC corporate VC setup. So it is balance sheet investing. It has to be strategic for us. So when we say strategic, there are learnings that we can get from a certain investment partnership. Can it help us accelerate innovation? And of course, we do focus on financial returns as well. And so we invest at HSBC, we invest across themes such as data analytics, operational efficiency, open banking, cybersecurity, crime prevention as well. In terms of ticket size, it varies. I think we tend to invest between a range of $3 to $10 million on a case-by-case basis. The initial ticket size could be less, or it could even be more. And to date, we've invested in over 25 companies across Europe, North America, the US, and Asia.
So you've kind of got somewhat of a evergreen capital type of situation to some extent.
I guess you could call it evergreen capital, but I think something you should, or one should bear in mind, is that we do prioritize. So there has to be a strategic angle. It's not so much to say that we do every investment. It has to be strategic for us. There has to be an angle for HSBC, a clear partnership model that we've identified with our investment company. So it is evergreen in the sense that it is from balance sheet, but frankly, we do go through prioritization in terms of who we choose to partner with and how we can gain from that partnership, and of course, how they can gain from that relationship with us at HSBC as well.
So I really want to kind of hone in on the CVC aspect, right? As you mentioned or alluded to a couple of times, uh, usually, CVC lends off its balance sheets. I mean, more particularly in this case. And what is it like running a cross-border CVC versus a VC? Do you have to report directly to HSBC's executive board? How does the relationship kind of work here?
So it's really about connection to the bank. So there has to be some strategic connectivity to the bank in terms of the relationship. For us, we need to be able to identify ways in which we intend to work with them, identifying sponsors within the bank, within the different business units and business functions. So we'll invest along, I've mentioned the themes that we invest in, but we do get support, and we work hand in hand with our different businesses and our different functions at HSBC. So it's the stakeholder, relationship, and managing that relationship is very important. In terms of reporting, I do have an innovation board that has at least 5 of the most senior members of HSBC's leadership team, our management team. So we do get attention from our innovation board, and the innovation board sets the strategy for the corporate VC arm at HSBC. But I think most important is not just the innovation board, but even our colleagues from different business areas that are stakeholders in this journey with us to make sure that we're able to leverage the investments that we have in these companies.
So I want to take a dive into your particular investments. So HSBC Ventures focuses on Series Plus investment funding rounds. And you've made investments across data and AI, open banking and networks, security, crime prevention, and identity, and operational efficiency. Within these 4 verticals, can you give us a breakdown of, kind of what they mean and what interesting startups you're seeing in each of these verticals?
Yes, obviously you've done your homework. We do invest alongside those themes. In terms of Series C, there was a time when that was primarily our focus. But in actual fact, if you were to look at our portfolio, you find out that about half of our companies were Series A and Series B investments, and the other half C and above. So it's a good mix of different stages of investment. I think the most important thing is engagement. And for us, right now, we actually have a great deal of flexibility in terms of when we come in. So the most important thing, I think, for startups out there, whether you're Series A, Series B, or C and above, it's how engaged are we with you, or how engaged can we be with you? And that will help in making, as we go thinking through the investment case. So in terms of our themes, security, crime prevention, and identity, of course, cybersecurity, areas such as KYC, AML are very important to us as a bank. It's a key strategic priority for HSBC. In fact, when you think of the whole idea of cybersecurity, it's gone past the days when cybersecurity was just a technology discussion. This is actually a discussion that's had at the board level. So this theme is very important to us. We've been very fortunate to invest in some companies like Crowdstrike, which is an endpoint security company. It was one of the biggest IPOs of last year. There are other companies, sort of Canada Security in the risk vulnerability assessment space. A more recent investment, a company called BioCatch, it's in biometric space. Quantexa is another company which is that we invested in. Quantexa as a platform to detect financial crime using real-time entity resolution. So those are some of the companies that we've invested in that. Under the security, crime prevention, and identity theme. Of course, data and analytics is another key area for us. Looking at innovations around data science, which everyone will agree with me is having a major impact on the financial services industry. And looking at how data can help with advisory services, be it even sales acceleration, and even risk management is a big thing for us. And data is a big part of our technology infrastructure. So investing in companies that are relevant in that area. Open banking and networks is another area for us. As you know, there's a degree of regulation driving this area. There is an increased need for device and application connectivity, for solutions out there. And open banking is a theme, especially in Europe. You find it very popular, but we're beginning to see that also in the US, where there are companies playing in this space. A company that everyone knows, not an investment of ours, is a company called Plaid. Would fall under this category. We've invested in a company doing something similar called Bud, based out of Europe. So we're interested in open banking, in multi-bank platforms, and financial intermediaries, and companies that can also help us in the digitization of supply chains as well. Not the list. The fourth one, operational efficiency. It's really, as it suggests, it's about efficiency. It's about looking at technologies that can enable automation, industry-wide utilities. We've invested in companies like Openfin, which is a desktop financial application. Vsolutions, another company that helps with taking the journey from just your one-to-one engagement over the phone, can help make sure that you continue on your journey as maybe a sales agent with a service provider. And you can see how we can apply this to different products and services that we as a bank are looking to engage with our customers. There are other companies that fall into these categories that are quite interesting. Companies in the work collaboration space will fall under operational efficiency. So all in all, it's an exciting time for us, and we've been very fortunate to find companies that we've invested in across all these four themes.
So, Ore, based on what you said, are there really any exciting future trends you're kind of seeing?
Well, I mean, there are quite a lot of trends. I'm excited about so many areas in financial services. I mean, an area that I think we're barely scratching the surface is sort of the BNPL, so buy now, pay later area. So you have the companies like Affirm, you have Klarna playing in that space as well. So it's really changing how we think, or how one thinks about credit. Thinking about the whole idea of instant gratification. So I had my Peloton that I bought using Affirm, and it's just the way you look at credit. I didn't have to use my credit card, and the person who actually taking the credit risk is actually quite different. So I think the buy now pay later space is going to continue to grow. The area of banking as a service as well, being able to provide services and even microservices for the customer, being at where the customer needs the solution, and being able to offer these solutions to the customer, I think it is quite interesting. So you do have lots of companies looking to play in the space of banking as a service. Embedded finance is another theme or area, a trend that is getting a lot of traction. So the whole idea of being able to, where finance is just, think of it as more or less a byproduct of the actual service that you're offering. So think about healthcare, think about HR, think about agriculture, where finance is just embedded into the core services being offered by these different verticals. So I find that very exciting. And of course, there are other areas, even like digital assets and things around infrastructure, around holding assets that I think we'll see beginning to see a lot of changes, a lot of innovation. Then, thinking ahead, also quantum computing. There's quite a lot of discussion around quantum computing and use cases, especially in financial services. So I think it's an exciting future in financial services. There will be opportunities that will open up to a lot of people, a lot of companies, and I think we're barely scratching the surface around some of these areas that I mentioned.
So some of the investments that HSBC Ventures has made have been in the growth equity investment space. And what type of financial metrics or multiples do you use or look at? Can you detail what the significance of each of these metrics is to potentially the overall valuation of a company?
I think the metrics are very important, as you suggested, with the growth rounds and just even early stage investments. The focus generally remains around growth prospects. That's what you actually invest in. That's what actually you're investing on. How you're able to capitalize on the growth opportunities that you see within a company within a particular space. So there are standard metrics if you're a SaaS company around revenue, monthly recurring revenue, or ARR. Looking at how you are able to onboard new clients, new bookings, and the upsell potential of your product as well is equally important. I think we do focus, as we look to understand companies or make our investment decisions, in looking at the market size and expansion as well into other markets, whether it's geographical or adjacent spaces, equally important as well. You think for Series C and D, Series C and above, there is a natural need to focus on historical performance as when you think about it, those target companies will have more data points. So your historical growth rates are probably more important as well, because frankly, there you would have made a case for a potential investor coming in on what you've been able to achieve. In particular, a metric is really understanding churn. What's the customer churn? We'll look into that in much detail for the later stage companies. As I think it's important to pay attention to beyond just the revenue line, also around expenses, and frankly, that speaks to revenue efficiency. So things like customer acquisition cost is important. As the company starts to journey towards profitability and exit opportunities, there's a need to start balancing how much it spends on growth and where it focuses on this to capture the most revenue. So efficiency is an important bit that investors focus on as well. I do, for your listeners, that are just looking into the area of how do you make a case, one should actually take time to read the S1 filings of some of the companies that are about to IPO. And it's always interesting to see how companies have achieved growth and how they intend to continue to achieve growth. So the S1 filing is a good way of learning how a growth story, which is what investors in the public markets are going to buy into. But even at the early stage, it's really about the growth story, and financial metrics are important. But that said, I think there's an art to it as well. It's important that you look beyond the numbers as well, understanding the track record of the management team, so and how they work well together. I think it's equally important, especially in the early days.
So when it comes to actually investing in a startup, right? The typical financing rounds are either convertible notes, SAFEs being a subset, or an equity price round, or in some unique cases, investing by common shares. And what are the main financing rounds you see in the industry today? And what have you typically done?
I think in terms of the structure that you use for an investment, it really varies on what the situation calls for. And sometimes there's a preference, but there's a preference by no pun intended by the potential investor to to do an equity round, of course, with preference shares. It really varies. So SAFE, as it suggests, what's most common about SAFE is that the SAFEs have very simple agreements. So, and that's usually done at the C stage. So we've not done any investment that is a SAFE. We've done mostly convertible notes and also straight equity, both common and just with preferred shares. And there are advantages and disadvantages to to these types of structures. As I said, SAFE, it's it's straightforward and very simple terms, but essentially it's but you have to know that it's essentially a warrant to purchase stock at a future priced round when you convert to equity. One, if you're doing a SAFE as a young company, you should be aware of the dilutive impact that could happen within that type of structure. Convertible notes, on the other hand, I think what's good about convertible note is the degree of flexibility that you have with such an instrument. And it's when you have there's greater control for founders in avoiding placing a valuation on your company, and it's good for companies that are just starting off. But you need to be very careful and understand that at the end of the day, this is debt, and you want to be very careful that you don't take too much of debt on your company as you start. With straight equity, which we do quite a bit with preference structure, if sometimes you have, well, most times you have dividends tied to it, so it could be a steady stream of income and guaranteed dividend. There's also flexibility as well for the preferred stock owners as they look to convert, which they may convert into common equity depending on the type of preference shares. Another thing to be aware of with preferred structure or straight equities around liquidation preference in case of company liquidation, and being very careful as what kind of liquidation preference you have. It's not always guaranteed. Con is like it's not always guaranteed within straight equity, and especially with preference shares that you always have voting rights. But we do always make sure that's always there. So for us at HSBC, it's really most of our deals have been in the form of converts or straight equity with a preferred structure in place.
Now, from the startup founder perspective, right, how do you recommend a startup founder approach their first few rounds of financing, right? It sometimes seems that when an investment is made or when talking through term sheet specifics or liquidation rights, etc., that the VC tends to be a little more protected than the actual founder when the agreement is finished.
I think first for every founder, I think it's important outside of the structure that you find the VC CVC that is right for you. And part of it, of course, structure will come into play, but you should look at the intangibles in terms of what you get from associating with a particular investor. What do you get from them? Is it introductions? Are they going to be able to help you with recruitment? I think a lot of founders underestimate the ability to get the right talent as they look to scale. So in terms of my recommendation for startup founders, as you look at your first round of financing, structure is important, but you should look at the other things in terms of what the investor is going to bring to the table. Of course, if it's very early stage, seed stage, I think using a SAFE is it's usually very good for a seed round because it's simple. As I said, converts, you don't have to worry about valuation, but be very careful. A convertible note at the end of the day is debt as well. But I think my view is with founders that you really focus on the right fit for you and what you look to get from that relationship from an investor. It's not just capital. If it were just capital, I think everyone would be able to or should be able to get funding because the market is awash with capital, but really finding the right fit for you, I think, is actually the most important thing for any startup founder. Who do you gel with? Who really understands your market? Who really understands where you're trying to go, and who has done it before? Talk to other people, talk to other founders that have worked with these VCs, with this corporate VCs, learn about their experiences, get feedback. And these are some of the factors that you should take into account as you approach your first few rounds of financing.
So really honing in on this strategic capital perspective.
Absolutely. That's very important. It's not just to me, every type of capital, even though traditional VCs may disagree with me, every type of capital is strategic in nature, because it's not just money that you're just putting in. It's the value. It's about value creation. That's what venture capital is all about: is value creation, and really making changing a market segment, adapting to changes as well, to capture value. So there is quite a lot of strategic thinking that goes into any partnership, for whether it's from a traditional VC or corporate venture capital outfit.
And to wrap up our call with our last question here today, Ore, what piece of advice would you give to people out there from the journey you have had so far in life?
From my little journey, not sure if I'm overly qualified to give advice, but I mean, things around, focus, dedication, hard work. I think that's very, most entrepreneurs have that, because just knowing without that, you're not likely to succeed. I think so they're the entrepreneurs. I think I've said a bit about making sure you are connected to the right investor. That's important. For those that looking to get into the world of venture capital, I think it's important to understand that you pay your dues. There's no quick fix to it. There's no cutting corners, and network. Get to meet people. Get to ask questions. Send the emails. Not every email will be responded to, but also be ready. Be ready when the opportunity comes, and be ready to step in and step up. That's really it. I think being an investor or being an entrepreneur is just one of the best, one of the most fulfilling things one can do, in my opinion. I've enjoyed every bit of it. I'm passionate about it. And, if there's one last piece of advice is, well, at the end of the day, one's got to realize that maybe none of these things really matter. That it's about one's health, but it's about your family, it's about your loved ones, and not to forget the things that make you really happy, because those are the things that are most important.
Ore, it was a pleasure having you on Geeks of the Valley, and thank you so much for joining us today.
Thanks for having me, Kunal.